we're live.
Live.
All right, got me. All right, so a couple things we want to do today.
That's on.
You guys take one of these?
Go ahead.
Here's this. So yesterday, for the ones that were here, we went over this asset inventory sheet that we're going to be using with our clients, and we talked about this. Is it? And we talked about at what point in time we would introduce it during what kind of sale. So if we're at a client and we're seeing them for the first time on a DCC, we're not going to introduce this because we haven't provided a value for them. So they're not going to. This is not the time to introduce this. This is going to create some friction. So we're not going to introduce it. We're going to introduce it once we provide a value. When we come back to the policy delivery, deliver the policy, then we'll introduce this. On the in-house clients, also, you know, when you go in there, a lot of times you're gonna be in a position where they don't trust you because it would occur to them. So we're gonna have to show them that we're gonna provide value for them. Again, policy delivery. And then you'll have the clients that you either already have a relationship with, or they've been serviced well by previous agents, and there's nothing we can do to improve their insurance situation, but at that point we can introduce the asset inventory. So those are, and then obviously referrals. At referral, we can always, as a matter of fact, this will be our strongest tool, because now we show them what we really do, right? They're already accepting us. They want us to help them. That's why that's why we're there. So we got to pull out the full arsenal. So those 4 situations, we treat them differently. Okay, so the introduction to the asset inventory is going to be this. And did you go in here?
No.
Wait, did you go in?
Oh, yeah, they have one.
Okay. Awesome. Okay. So remember we were talking about how we're going to do like a 4 or 5 part IUL and annuity training? Mm-hmm. Well, this is going to be the second part of it. Yesterday we did but we're going to be using an asset inventory so much that it's okay if you weren't here yesterday for it, because it'll be, as a matter of fact, the next one we'll sit down and go over how to ask the questions on there. But real quick before I forget, I wanted to put on here Saturday options for appointment setting. I have some really cool, exciting stuff about this for Saturday. Okay, guys, so this is the keys to the castle right here. Okay, and so the way it goes like this is, either, regardless of what it is, when you're ready to introduce it, it's going to be Mr. and Mrs. Jones. I want to take a moment to apologize for becoming overly concerned with getting you the mortgage protection that I failed to mention what I really do. Okay, my objective was to get you the mortgage protection, make sure that you're covered, and it slipped my mind on being able to show you exactly what I do. What we do is we actually help families plan for their future. We help clients with financial solutions to plan for their retirement future, okay? Now, our mission in the financial services industry is to help educate our clients on supplemental retirement. 9 out of 10 times it's out of fear that an individual has not prepared for their financial future. So our mission, Mr. and Mrs. Jones, is to create financial independence by using an educational approach, okay? And here we go into this, and this is going to be where we start getting into drawing them in. So remember, we don't ever talk about financial planning. You will in the near future once you're over 65, but right now we don't talk about that stuff because that's a big no-no, obviously. So we talk about supplemental retirement, financial map or plan, financial future planning or supplemental retirement planning, anything like that. Okay, so what we're going to teach you is the basic building blocks to reaching your financial goals. If you called most financial planners or coaches, they would charge you approximately $500 to $1,500 for this service, guys. It's basically a filtering process. They only want to deal with people with money, right? The wealthy. We want to take an educational approach and deal with 80% of the population, which is middle class and upper middle class America. We're going to find out where you are, where you want to be, and then we're going to give you a map on how to get there, okay? This will remove any fear, any uncertainty, and get you excited about the future and where it's going. Once I do this, you'll tell everybody about me. Is that correct? Right, absolutely. You're gonna love me. Okay, so there's 3 areas we're going to look at today. And so this is going to be, we're not going to get into the financial inventory yet at that point. We're going to talk about the 3 areas. So first area is increasing your cash flow, looking at where we can take costs, or we can cut costs, save you money, hit your budget, bring you some financial freedom, ensure that you have proper protection, protect your assets and loss of income, life insurance, right? Emergency funding. You can explain to them that they need to have 3 to 6 months of income in the bank. Asset accumulation. Now this is where we're going to step in, right? This is our IUL or annuity or anything like that that we're going to be able to provide. By the way, guys, increasing your cash or looking at where we can cut costs, you don't do anything. All you're going to do is in the asset inventory, you're going to ask what they're spending their money on. And you're going to find out how much they're saving. And you're going to find out, and all you're going to do is say, so obviously you see what I see, right? You're spending $300 on entertainment a month. You're doing, you know, your cable bill. Is there anywhere you see that you can save money that you don't need? Guess what? You're not doing anything. All you're doing is asking them, and they're going to tell you, yes, I actually can save $150 on entertainment a month, or I can cut down my cable bill, or I can do this. But did you do anything? Did you do any advising? No. All you did was show them. Questions. Yeah. All you did is ask them questions, and they're doing their own problem solving. Okay. So the reason we do that is because as a professional in the financial services industry, you have to look at all aspects. Unfortunately, because you only have a certain amount of ability to be able to talk about certain things due to licensing and, you know, limitations like that, there's a way to approach certain things without having to violate any rules or regulations. And when you do that kind of stuff, you write stuff down, and they see it, and you say things like, "You see exactly what I see." I mean, this is clear, cut. You know, it's cut clear. It's crystal clear. You're looking at how much money you have, how much money you're saving, and where your entertainment income going, or where, you know, eating out income is going. All that stuff, right? So you tell me, where can you make your cuts? Where can you help yourself for your financial future? What can you take away from to help supplement your future? And they're going to tell you that. Oh, okay, perfect. And you know what? Guess what? They did everything. They're the ones who did their own financial planning on that, as far as that's concerned. Okay. If the client agrees to move forward, then at that point we introduce the asset inventory. Okay. And on that asset inventory, you're going to have tons of questions. Of course, by this time, regardless, unless it's a referral, we're going to have all the information, right? Mm-hmm. Because we're going to have all their information, and what we do when we have all their information, you write it down and we spit it back out at them, right? Regardless if you were there last week, you're going to do this because at this point, it's going to affirm that you have all their information already. You're already personal on the level that you have sensitive information, and anything else asked of you at this point is just supplemental to what you already have, right? So you're going to go through the asset inventory. Again, we went through that yesterday, so we'll take a time later to do that again. But in that asset inventory is going to be certain questions about their financial situation, about how much they're putting away for retirement, about what their goals are. You know, all these things. Again, all we're doing is writing it down and letting them see the picture. Okay? Because when they say, "Listen, I'm spending $400 a month on eating out, but I actually want to retire at 65," nobody needs to tell them that they need to cut somewhere and use that money for something else. We don't need to do that. They're going to see that themselves. They just haven't seen it yet because it hasn't been mapped out for them. Right. So then we get into there's 4 types of people, and this is extremely important. Okay. First type of person is the broke, and a lot of people think they're broke, but they're actually just mentally broke. And what that means is that they don't pay themselves first, or they don't have a plan or a map for their financial future. The second ones are the 10% savers, which is actually most of the population that falls into this area. We consider this the average. They save 10 cents out of every dollar, and they have a commitment. They have a commitment to their map. 15%, which are considered good, 15 cents out of every dollar, putting away for their future. A lot of times these individuals start at 10%, and they're able to increase to 5% to 15%, and they grow into that. So, you know, a lot of times with these situations, you want to take baby steps. It's really hard to go from 0 to 60. So, you know, real quick. Yeah. So, 25% is considered the great savers. These are the people that are on track for retirement. They're in a place where they're going to be financially independent. Now, quick question for you. Listen, you can be, this is gonna be completely honest with yourself. This is just, doesn't matter what you tell me, this is, where are you on this? Out of these 4 people, which one are you? Okay, okay. With that said, where do you see yourself right now, right? And then wait for them to answer, don't say anything. And where would you like to be? And where do you think most people are gonna say, and where do you think most people are gonna wanna be, right? So more people are gonna be broke or 10% savers, and most people are gonna wanna be in the second tier, which is 15 or 25. So most people will say, I'm here, but I wanna be here. That's it. So with how much are you, now we've already looked at how much you're spending, how much you're saving. Now, out of that money that you said you're spending on entertainment a month, or the additional savings you have, how much of that would you be able to put away to help supplement your financial future? Now remember, you're not talking about sales here. All you're talking about is helping them out. All we're doing is coaching them, okay? How much of this money can you save from spending on something you don't need, so you can help yourself for something you do need, which is your financial future? How can you help yourself? How much of it? How much of your money can you use to help yourself? Okay, well, and then this is what we talked about yesterday, is they're gonna give you numbers, and a lot of times it's gonna be unrealistic. I mean, you're gonna have a 50-year-old guy who's gonna tell you, I can put $100 away and I wanna retire at 62. And you say, hey, listen, I wanna stop you right there, okay? Because your mortgage right now is $2,000 a month. You're telling me you wanna put half of that on a yearly basis away for your retirement, and you wanna retire in 12 years, your mortgage is a 30-year loan? How is that? Now listen, if you're 20 years old, because compound interest is such a strong concept, that would probably make sense, okay? But you're not in that position, and I'm not gonna waste your time, and I'm not gonna waste my time. A lot of, salesmen, and I'm not a salesman, I'm a professional, would take your $100 and they would make a sale out of it, and they would make a commission. But I'm either gonna be able to help you or I'm not, okay? And so in order for me to help you, I have to be realistic. Now, John, you're spending $400 on food, or going out, entertainment. You have cable that's $200, and you're saving, you said, about $400 a month. So you have a residual of about $1,000. What's realistic? How much money can you actually put away for your financial future, right? And then they're gonna be like, okay, $250. Okay. Well, listen, again, I don't know how realistic that is, but I'll take the $3,000 that you're willing to put away yearly basis, and I'm gonna go back to the office, and I'm gonna run I'm gonna run a map for you, and I'm gonna show you how it's gonna look. I'm also gonna come back, if it's not realistic, I'll come back with a realistic number. And then we're talking about vice versa. You get clients that are extremely excited about what you're gonna tell them about tax-free and income stream and all that stuff, and they're gonna jump in and say, oh, I'll put $1,000 a month, right? And it's unrealistic as well, right? So what happens is you come back and they're like, you know what, the truth is I can only put $250 a month.
Right.
Yeah. Right, it happens. So by the way, these are never a one-call sale, never. Okay, you go in there with a one-call sale, and you're just a traditional salesperson that is looking for a quick sale, okay? It doesn't matter how, it's perception. It doesn't matter how great you are at it, you take this back with you, and you call them back, or you set the appointment right there and then for a week later. It's gonna take me a while to put a plan together for you. But once I do, it'll come back and it'll be fully customized to you. I can see you next week at so-and-so time. It's gonna take me at least a week, okay? So when you come back and you do that, now you're a professional, right? So you take all that information, and I'm being serious about the whole, don't take the $100 a month from somebody that's not gonna benefit from it, because they're gonna see that right away. I mean, it doesn't matter how much percentage you put, 15, 20% on $100 a month for 12 years, it's still not gonna show, anything. I mean, it's crazy how compound interest. I'd rather have 4% over a 30-year period than 15% over a 10-year period. That's how it works, If I can get the map, if I can get you a map, next sheet, that is going to meet your financial family needs, fits your budget, and gets your goal of 15,000 supplemental retirement, is there any reason that you wouldn't tell everybody about me, John? Of course you would, right? Now, the objections are going to be several, financial planner, And you talked about the map. If they already have a map, ask how they're working for you. Have you lost any money, right? And if they may have. We would see a client of agent recently for an an annuity, and the wife had lost like 50% or more in her 401k, and she had no idea that she can move that into a secure vehicle. She didn't know. Do you keep any contact with your financial planner? And this is easy. First of all, most of the people we see do not have a financial planner, right? And so any fees associated, of course there's going to be fees. If you're a financial planner, there's going to be fees associated with it, right? If no, and you don't have to address any of these, then let's go ahead and get started. During the process, you'll probably be thinking of people as we go along, and at that point, stop me and we'll make a note and come back to them later, okay? 3 enemies of your money. This is another huge thing, okay? The first or the third one is inflation. Average rate of inflation today is about 3% a year. And now you're barely beating inflation when you're keeping your money in a savings account or a bank account. Now we know that savings account earns less than 0.5%. A checking account earns less than 0.5%. Savings account maybe 1%, right? What is it? CDs? It's like, short-term CDs, 2% or whatever, and you have to lock them in and not liquid. So you're not even keeping up with inflation. Taxes. And you need to understand the tax implications of where you're putting your money. Most people don't know this. Okay, this is impactful and it's huge. You make it, they tax it. You spend it, they tax it. You retire, it's too late to make adjustments. They still tax it. Okay? And then the number one enemy of our money is ourselves, because we procrastinate and we never save the money we need in order to have financial independence. Now this should come first. Don't you agree? Now you're committed to saving. If you're committed to saving, you're taking care of number one. You're taking care of yourself. I'll take care of number 2 and number 3 for you, okay? That's what I'm here for. Now, John, there's 3 types of accounts, okay? 3 places you can put your money. And the first one is the IRS. Is very specific about the definition. Is that they say, Mr. Jones, we can tax you now, we can tax you later, which is tax deferred, or never tax you at all. Now, if you had an option, where would you put your money? Tax free, right? Tax free, right? Of course. And that is what most of my clients would say, but very few of them have their money there. Why? Right? It's because they're not educated. Okay, and that's what we're doing here today. So the advantages and disadvantages. Let's go over the advantages, disadvantages, and 3 options. Tax, CDs, checking, savings, money market, mutual funds, stocks. So stocks, you have capital gains, 20% tax on long term, 33% tax on short term. As a matter of fact, that's changed. It's actually now 39.4%, 39.6% on short term, 39.4% on 39.6% on short. No, sorry, 39.4 on short term, but the long term has actually gone down. It's actually 14.6. Okay, but still, you pay taxes each year on your gains. Okay. Tax deferred, 401k, 403b, IRA, SEP IRA, annuities, deferred compensation pensions. You pay taxes later. You can't access your money until you're 59 and a half. You have to take the money at 70 and a half, where you have the RMDs at that point. And you have your early withdrawal penalties. Okay? Now the last one you see, there's tax-free, and there's only 2 vehicles in there. There's a Roth IRA. By the way, do we know how the Roth IRA works? Roth IRAs, there's a ton of limitations. If you're single, you have to earn a certain, and it changes every year. If you're single, you have to earn a minimum or a maximum amount. I think it's like 60,000. If you're married, it's like 120,000 or 110,000. Anything over that, you can't qualify. You can't put money into this. And then there's also a limitation on the amount of money. If you're single, it's like 5,000. And again, the contribution amount goes up and down. So you max that out fast, right? Now listen, John, take advantage of the Roth IRA. If you're already doing that, fantastic, right? But the problem is that you're gonna max it out. I mean, 5,000 away for your retirement on a yearly basis is nothing. You're making 100,000 a year, putting 5,000 away in your IRA. Well, first of all, you're making 100,000, you can't be putting 5,000, right? Because you made too much to qualify. So if you make 60,000, which is a max, and you're putting away 5%, how much is that? $3,000. $3,000. Do you think $3,000 is going to put you in a position where you're going to be able to retire? No, absolutely not. Okay. So it is good to take advantage if you can. But here again, all the rules apply to it. Okay. Now, last we have an indexed IUL, which is it's basically tied to what's called a code in the IRS. It's IRC 7702, which allows an individual to overfund a life insurance policy for supplemental insurance purposes without paying taxes. Okay. Now, what happens is there's no income. It's income tax free. You have access to your cash value anytime. You're liquid, and you don't have any penalties. Okay. Also, and I'll tell you a little thing about it. It comes with the life insurance plan built into it. But I'm not going to get into that right now. So listen, Mr. Jones, if you had an option to put your money, where would you put it? Tax deferred, or tax free? Absolutely, right? 100% tax free. And above that, if I could tell you have access to that money tax free at any time, how'd you feel about that? There's a way to do that. Now, here's the thing. And I get too excited about this. I'm very passionate. I get excited about this and I start going a little overboard. Unfortunately, just like anything else, you have to qualify in order to be a member of this club. You have to medically qualify, okay? Means that you have to take a physical. Insurance company has to make sure that your